Hi, I'm Jim Rocket from San Francisco. I'd like to pose the question to John Allison, which is, the government now is an investor in most of our major financial institutions, and through that investment, they believe they can control the pay structure of those institutions. As the CEO, former CEO of an institution that did indeed get into this, and now the chairman of the board of one of those institutions, what is your view of how the government is going to manage that pay structure, number one? And number two, is it going to seep down into institutions that haven't taken TARP? And number three, is there going to be a consequential brain drain from the banking system that is virtually going to create an irreplaceable resource for the banks?
I think the answer is yes, yes, and yes. They are already attempting, have made announcements about managing the pay structure of any insured financial institution through the FDIC, which technically they believe they have the right to do. What we've seen in their original proposals is way beyond executive management. That's an interesting challenge. For example, BB&T is very large in the insurance brokerage business. We're the 6th largest insurance broker in the U.S. Many of our insurance producers, because we do very sophisticated insurance products, made more money than I did as CEO. Under this program, we won't be able to pay them what the market will pay them, and we'll lose them eventually if it finally ends up that way. Ultimately, it will create a lack of market discipline in the sense that people can't really allocate pay. And what it will do, they will reduce the risk taking. But here's the interesting question. Do you really want the risk taking? Yes, you don't want dumb risks to take. But one thing that drives an economic system is the willingness of financial intermediaries to finance entrepreneurs. And if you drive out risk taking because people can't be rewarded for taking it, it will be a huge negative for our economic system. So I think it's very, very tricky area.
All right, alternating to the other microphone.
Well, I thought the whole panel was very interesting, but I too have a question for Mr. Allison. I understand that BB&T took TARP money. Can you talk to us about the factors that went into that and if it's been paid back?
Well, it's a very interesting experience. I was adamantly opposed to TARP. I wrote Congress saying that I thought it was a terrible idea. Had no success. But then once the TARP program was passed, we had an interesting conversation with our regulator, the way this always goes. The banking industry's had capital ratios for many years defined by the regulators. We had way, way more capital than needed based on those ratios. But we were informed by the regulators that they were going to have some new capital ratios. They didn't know what they were going to be, but they knew we didn't have enough capital. True conversation, literally true conversation. And here's why that happened. Remember, Bernanke is a, quote, student of the Depression, which is very dangerous in academics. So he assumed we were getting ready to go into the Depression. And he looked back to the history of the Depression, and what happened in the Depression, Roosevelt tried to save individual institutions initially. And when he did that, the market immediately reacted against him. So Bernanke knew there were 4 large financial institutions that were on the verge of failing. We could see that in the capital markets. We knew they were getting ready to go. But he knew if he saved those 4 institutions, then the market would jump on them. So he forced all the $100 billion banks and above. He just picked $100 billion and said, you're going to participate in TARP, so you can't figure out who's the problem. And then it's an interesting thing, the way the plan, in my opinion, to pay for TARP, it was a huge ripoff for healthy institutions. We didn't need the money. We were the first bank to pay back TARP. They did these stress capital ratios, and we had way more capital than needed, so we never needed the money. But we had to pay a 9% interest rate. We had to offer these warrants, and the total cost of BB&T was $250 million. So we effectively paid $250 million to subsidize our failing competitors. So it was almost like a tax on healthy institutions. That's how it looks like in the real world.
All right, question over here.
Yes, my question is for Mr. Black. You had a lot to say about mortgage brokers and banks. My best friend owned a mortgage bank, and he described it as a box of qualifications that a person had to fit into to get a loan. And Fannie and Freddie and some of the people like Countrywide, Argent, they just kept expanding that box. And he didn't make up numbers or anything. he just found as many people that would fit into whatever box they were willing to give him. So what's fraudulent about that?
Oh, as you've described it, nothing, if that's all that happened. But remember, this is not Fannie and Freddie overwhelmingly. Fannie and Freddie did not purchase the Alt-A and subprime mortgages and pool them themselves, with some fairly rare exceptions. So I don't know what portion, if he must have been in the prime market as opposed to subprime and Alt-A if he was selling directly to Fannie and Freddie.
Fannie and Freddie owned hundreds of billions of dollars of Alt-A and loans and subprime securities, but Alt-A loans, they did buy them. It sounds to me like your story's true.
But they did this overwhelmingly in the context of CDOs, right?
No.
So they have very small.
They have them in portfolio.
They have.
And moreover, they were buying at the top.
Yes.
And I'm willing to credit that to a mistake on their part.
Well, I'll credit it to worse than that, okay? If you think I'm a supporter of Fannie and Freddie, you're really off, okay? I was a government expert witness against Frank Raines. If I had it to say, you wouldn't privatize Fannie and Freddie, you wouldn't have them exist, all right? But Fannie and Freddie are laggers, not the folks who led this. And if you want a really good article by folks congenial to most of the people in this room, it's the Hudson Institute, John Weicher, and his title says it all. For the GSEs, the goal was always profit. Fannie and Freddie were driven by their compensation system. And empirically, like most compensation systems, it was heavily weighted towards short-term accounting, quote-unquote, profits, actually even more gimmicked, and earning per share stuff that was excluded a lot of things that were harder to gimmick. And they did things to maximize their bonus because they were private in their orientation. They could have cared less about poor homeowners. They were focused entirely on their bonuses. And if you want to be inside the real world of Fannie and Freddie, that's the real world inside Fannie and Freddie. And remember, OFEO, the entity regulating it, was run by a conservative, partisan Republican, close friend of President Bush, who had every authority in the world in the existing regulations to tell them to stop buying any and all subprime and Alt-A product.
So if the fraud's at the top,
there were no such actions, and it had nothing to do with Dodd. It had to do with their view. I talked to all of the senior leadership. Their view, it was illegitimate to regulate Fannie and Freddie unless they could prove that it was going to definitely cause catastrophic losses. So they didn't get your analytics that you pointed out. Did you meet with Lockhart?
Oh, yeah, Lockhart knew they were in trouble.
Well, and what's your view on why Lockhart didn't act?
He felt like he couldn't act. He felt like he was restrained. Here's what actually, remember, we're a client of Fannie and Freddie, so we're producing loans for Fannie and Freddie. They had been in the prime market. They really didn't want to get in the subprime market because they knew how risky it was, but they were under a huge burden under Congress. Now, this did start with what you can call fraud. What happened is once they had accounting issues at Freddie and Fannie, then the issue about them continuing with the guarantee became a huge issue. And so they had to do whatever Congress wanted. And the only way they could get Bernie and Dodd to go along with keeping the guarantee was to do a bunch of mortgages that the new management of Freddie and Fannie didn't want to do. They knew it was highly risky, but if they didn't meet this affordable housing goal, they weren't going to keep the guarantee. So Congress was pushing them because, I mean, affordable housing is a great political kind of thing, and they didn't believe it was risky because they had all these studies that people had had bad problems in affordable housing. The problem was the market was much smaller. And here's a double, and then you can call this fraud. Freddie and Fannie called a huge portion of their portfolio to Alt-A's. Well, it turns out they were subprime. Well, that means that the private market, looking at information on Freddie and Fannie, did not have any idea how big the subprime market was because Freddie and Fannie were calling a bunch of stuff Alt-A that was subprime. And so the implication was they weren't taking the risk they were taking. And that was actually what was happening in the numbers.